What's going on, ladies and gentlemen? ANZD here with you, and I want to talk about the Federal Reserve recent FOMC meeting, where in June 2024, the Fed meeting, they maintained current policy rate and sees only one rate cut for 2024. Now, I don't know if you remember, but before they were saying that it might be 3 rate cuts. This is going back towards the beginning of the year where they said it might be more than 2 rate cuts because of how the economy was going, and that inflation was going down, as well as the economy seems like it was doing what it was supposed to be doing because there was more the job market was better, just a wide variety of things. But for the FOMC, we had CPI data, we had PCE data, we had some macroeconomic stuff that's coming out of Asia, just a wide variety of things that happened this week, which included the FOMC June 2024 meeting. So with that said, the market was all different reactions with the market. But what I want to do right now is get into this article from jpmorgan.com. And this article is by John Veit. And John Veit in this article talks about how at the current policy rate that they see no recent cut coming up or any cuts coming up. So the Federal Reserve left rates unchanged for the 7th consecutive meeting and now envisions only 1 rate cut in 2024. Now that information is kind of interesting because I just realized that it has been the 7th consecutive meeting and there's no rate cut, there's no unchanged, there's no inflation hike, there's no interest rate hike or anything like that. So let me get into a little bit about this article right now from John Veit on the jpmorgan.com website. So the Federal Reserve announced at its June 2024 Federal Open Marketing Committee meeting that it would maintain the overnight federal fund rate at the current range of 5.25 to 5.5. The decision marks the 7th consecutive meeting in which policymakers have opted to hold rates steady and keeps the federal fund rate at the highest target range in 23 years. So the federal fund rate at the highest targeted range in 23 years. So that's dating back to the late 90s. And I don't know if you know a lot of things about the 90s, but the 90s, to me, in my opinion, was a very large economical boom. There was a lot of things. There was a lot of movers and shakers, a lot of big things going on in the 90s. Some I'm not going to discuss in this video, but there was some things that was making the market move in the 1990s. I'm just going to say it could be legal or illegal, but that's all I'm going to say. But in the 1990s, a lot of money was moving because of that situation. So the FOMC statement was largely unchanged as expected. The Fed reiterated its commitment to its total goal of lowering inflation to its 2.0 target range. And right now we're at 5.25, 5.5. So that's going down almost 3% for their target range, achieving the maximum employment. While inflation has slowed recently and the job market has become more balanced this year, the uncertain economy outlook keep the Fed highlighted attentive to inflation risk. So they don't really want to cut the rates right now and then all of a sudden have inflation going back up again. Then they will have to hike the rates back up, and then next thing you know, we'll probably be in some kind of stagflation, inflation kind of economy. So Powell acknowledged that the committee has seen modest further inflation progress, a notable shift from his prior statement indicating there was a lack of further progress. Man, so Jerome Powell just be saying some stuff. I gotta check out that whole meeting and the follow-up press conference. The FOMC statement reiterated that the economy continues to grow at a healthy pace that is too strong to achieve its dual mandated, hence the need to interest rates to be held higher for a bit longer. All right, I'm not no economist, I'm not no financial advisor, nothing like that. I'm just trying to understand. I just trying to understand this economy, this finance, all this stuff. So I'm going to read that statement one more time if y'all don't mind. So the FOMC statement reiterated that the economy continues to grow at a healthy pace that is too strong to achieve its dual mandated. Hence, the need for interest rates to be held higher or a bit longer. Okay, so I kind of making sense of it. I think it kind of registered in my head. So basically, since the economy is doing good, interest rate is steady, not exactly declining, but it's steady, as well as the job market is healthy, people have jobs. So what that is indicating that most likely people will be prone to go out and spending more. But if you keep the interest rate higher, then people will hold back from spending more and be able to, in the long term, have the interest rate go down. That's what I get. Let me know your comments or what you see. So May's hotter than expected labor market data show parts of the economy are more resilient than most thought. While May's inflation data was a step in the right direction, a softer runoff pace of security holding continues. The Fed announced that it will continue to maintain the slower rate at which it's reducing the size of its balance sheets. They announced that at the May FOMC that they was going to reduce the balance sheet. So this marks another step towards more accommodative monetary policy. So for the summary of the economic projection, the much anticipated summary of the economic projection, SEP, proudly meet expectations with higher inflation forecast for 2024 and less easing this year. In response to this adjustment, Powell commented in it, it is probably going to take longer to get the confidence that we need to loosen policy during his press conference. So it's going to take longer. Might go into the election time, might go into 2025, not to mention the debt ceiling, all the other stuff, the budget. A lot of things going to be going on into the election, into next year. So a significant data points in the dot plot shows a year-end median federal funds forecast of 5.1, which implies that there will be just 125 basis point cut by the end of the year and for 25 basis point cuts in 2025. This is a reduction from the 3 cuts forecasted back in March meeting. So remember, like we said earlier, back in the beginning of the year, they were saying that there might be 3 forecast cuts for the year of 2024. Now it's seeming that it's going to be 1 for 2024. So let me just get into this a little bit more about this article, and then we're going to wrap it up, and I want you to leave some comments and stuff, all right? So economic and monetary policy outlook remain uncertain. There's no doubt over the past 2 months that economic variables are trending in a right direction for the Fed to eventually begin easing, but the Fed remains cautious about cutting rates too early. Chair Powell, we already discussed that because they don't want to cut too early, and then all of a sudden we're going to have inflation, which could be higher inflation, leading to like inflation, stagflation, and a variety of things. So Chair Powell underscores that the Fed's decision on the direction of rates continue to be made on a meeting-by-meeting basis. So the Fed is able to extend the wait-and-see posture as they continue to enjoy the luxury of a relatively strong labor market. The labor market has helped to keep the consumer resilient despite diminishing purchasing power from higher rates. So consumers might start to have to change their purchasing power and start to adjust to the way the economy is. And in the press conference, Powell emphasized that restoring price stability is essential to achieving maximum employment. Our view remains unchanged. We expect the Feds to start cutting rates by year end as inflation continues to be moderate. This should allow the Fed to be patient, keeping rates higher for longer, and not delivering rate cuts too soon. Market reaction. So the market reaction for this news was U.S. equities were mostly high in the afternoon following the Fed's announcement on June 12th, with the S&P 500 increasing by 0.9% that day. Simultaneously, the Dow Jones Industrial Average declined by 0.1% and NASDAQ increased by 1.5%. So it's a variety of things in reaction to the market. Investor sentiment was slightly boosted after the FOMC meeting, as it offered little surprise because they was expecting more idea of probably a couple rate cuts, or just they was expecting different things, especially with the CPI data. But now that came out, CPI data came out, the FOMC on the same day, the market reacted very different. So once again, this is Ainsley D. Hope you got some value out of this, and I'll talk to you later. Peace.